So when it comes down to like buying a home, like what do you want to show? That's a really great question.
So $1.5 million home. How about I'm actually pulling. I'm gonna do the math while you're here. You know what I'm saying? So if we want to get a hold on, I'm gonna get a mortgage calculator.
Let's get a mortgage calculator and figure out how much is your monthly payments going to be. Because this is what the lender is looking at. You know, based upon what you want to get a pre-approved for, they're going to see, you know, how much assets do you have to qualify and to sustain that. So for a $1.5 million house, if I'm not mistaken, it should be between $8,000 to $10,000 a month for that mortgage.
Woo! Hold on a minute.
Where I'm at.
I'm typing it in. Down payment, you want to put down 20%. That's going to be,
20%.
you know what I'm saying? No, I'm going to do a 30-year fixed rate. Right now, interest rate's about 5.5.
Yep.
And then, interest rate, all right. Yeah, so you're right. So my total mortgage, dude, come on, girl. You know what you're talking about.
I know my numbers.
A $1.5 million home with $300,000 down on a 30-year fixed rate at a 5.5% interest rate, with your property and taxes, your property and interest, property taxes, home insurance, and HOA dues. You don't have PMI in this because we put down 20%, $8,345 a month.
Period. Let's go.
Let's go. So if I want to have a mortgage of $8,345 a month, and I make my company grosses $500,000 a year, is that enough? Like, what's the strategy there?
This is a great question, because really now, and the good thing about you and our strategies is that now you're playing on two sides because you're on payroll.
Ooh.
So a lot of entrepreneurs,
come on, talk to us.
A lot of entrepreneurs struggle to get pre-approved for mortgages because they only have their business income, but not a proper payroll system. But with a lot of our clients, part of our strategy is putting you on proper payroll, because now you have two streams of income that they're looking at.
Yeah.
We're looking at payroll and also in that business income. And the good thing about having payroll, lenders look at that with a lot more value, obviously, because it's more routine, it's more fixed. So you can typically, to get a $1.5 million mortgage, you probably need to show at least, I would say, $400,000 AGI. Okay. Pretty much.
Okay.
So with like a $250,000 salary, which is, you know.
Pause. You said AGI, adjusted gross income, right?
Adjusted gross income.
I just want to make sure y'all got it. AGI, yes. Adjusted gross income. See, I know myself. Don't be trying to play with y'all. I just want to make sure y'all know it. All right, so to get a $1.5 million home, then you show an adjusted gross income of $400,000.
Around $400,000. So a lot of people, like, you know, if you are married, it's easier, because imagine, you know, you have a $200K salary and so does your spouse, y'all can get 1.5.
Yeah.
For sure.
Yeah.
So if you're by yourself, you can still pay yourself a really big salary. Then also you have the net income from your business that gets calculated into your AGI, and then you can now go ahead and apply for that mortgage. It also does depend on your cash flow, because even if you don't have enough, but you still have really strong cash flow and really great bank relationship, you can still pre-qualify, because they also weigh heavily your credit score. Are you loanable, right? Because we have to get into that whole concept.
Yeah.
Your credit score does matter as well, because you can have, you know, $400K income, but bad credit score, and you still won't get that $1.5 million mortgage. Wow. So your credit score does weigh heavily, but with strong income, great cash flow, a great credit score, you should be able to get pre-approved for what you want to get pre-approved for.
Absolutely, all day long. So it's like I want to make sure y'all got it. You're gonna have your personal income on payroll. She made me get on payroll. We use Gusto to pay myself and all the employees. And then you also educated me on to not pay myself too much, because then I lose certain tax benefits.
Yes.
So we'll talk about that in a little bit. See, I'm trying to tell y'all, I'm learning the game. I'm learning the game. And so I pay myself on payroll. We pay myself 6 figures. Actually, I pay myself the same way I pay CJ, so 6 figures. And then because I am the sole owner of the Neatness Network, I actually, the net income, adjusted gross income on the business side, also benefits me when it comes to getting
Exactly.
So it's like, let's say for an example, if I pay myself, for an example, $100,000 a year. Well, $100,000 a year is not enough to get a $1.5 million home. But if my company made $1 million and the adjusted gross income was $400,000, and I made $100,000 over here, so that means now they're looking at $500,000 as my income, because I'm the sole owner of this company.
Exactly.
What if I was a partner, a 50-50 partner?
So same thing with partnerships. You file one corporate return, which is the partner.
Yeah.
Each partner is going to get a Schedule K-1.
Okay.
That K-1 shows that partnership's share of income or losses. So with the $500K, 50-50, then you'll show $250 in your return, and your partner will show $250 on their return.
And that $250 will go on top of my $100K.
Exactly. So now you're at $350. Exactly.
$350.
Mm-hmm.
This is so good. I hope y'all taking notes. Rewind this if you need to rewind it, because this that stuff that we need to know.
Mm-hmm.
I have some people who are business owners who are watching me right now.
Mm-hmm.
And what they do is, I think some of them actually don't pay themselves nothing at all.
Mm-hmm.
Then I've met some who pay themselves, in my personal opinion, too much. And I'm like, my CPA told me don't do that, AO, because then now you're getting taxed on all that income on the personal side when you could have kept a lot of that on the business side and write off legit. But then he said there's something else that you could do to pay yourself at the end of the year. What is that called?
So you can always take owner's withdrawals.
Owner withdrawals.
Yes. So this doesn't affect your income statement.
Okay.
What it does affect is your balance sheet. So your balance sheet in your equity section, that pretty much shows like your ownership stake in your business.
Okay.
So whenever we're contributing, so I'm sure, to get your business up, you had to invest in getting it incorporated before you made any money.
Yep.
You probably had to invest in your equipment before you made any money.
Yep.
So because you were financing these yourself, these are what we call owner's contributions.
Okay.
So you're contributing these to your business. So you have a positive equity balance.
Okay.
So you can pay yourself back out from that and take the withdrawals.
Okay.
Now, once you take too much withdrawals, you now have negative equity in your business, which is not healthy at all. So sometimes when it comes down to mortgage lenders, they'll look at your balance sheet. Even though your income statement is hidden, if you have negative equity, that can also adversely affect you when it comes time to apply for a mortgage.
And when we say negative equity, that means that, break that down a little bit more for the people. Okay, so wait, what does she mean by negative equity? So if I have $100,000 in the bank account, does that mean that they went negative, or like it just means that you can't justify why you spent maybe $25,000?
So pretty much negative equity will just mean that, so what encompasses equity is owner's contributions, net income. So every single year that increased your equity balance, what's going to reduce it is withdrawals, right? And that's just the basic equity calculation. There's a little bit more that goes into it, but for our purposes, we'll keep it there. So imagine a scenario where you contributed $10,000, your business netted $50,000. We withdrew $100,000.
Say it one more time.
So we contributed $10,000.
Okay.
Business netted $50,000.
Okay.
And we withdrew $100,000.
We're negative.
We're negative, right? So it's like, how do we withdraw $100,000?
Right.
Well, what happens sometimes is people leverage business credit a little bit too much. And guess what? That gets added in the liability section of your balance sheet and also on your equity section because you didn't use that $100,000 to produce any extra income and increase your equity. You used that $100K, did the wrong things, and now you pulled out too much, and now you have negative equity. And this is so important because a lot of business owners pay so much attention to their income statements, but they have no exposure to their balance sheet. And your balance sheet really does it shows the health of your business. So your income statement that's only a once a year thing. Your balance sheet kind of pretty much is around for the duration of your business, and it gets adjusted every single year based upon your assets, which is your cash in the bank, accounts receivable, et cetera, your liabilities, who do you owe, your credits, your loans, and your equity, as I said, your owner's balances, contributions and withdrawals. So you need to be understanding of both, and that's why with our bookkeeping services, we do accounting analysis.
Absolutely.
Exactly. We're going through your statements with you and showing you, here's how much you made on the income statement, but here's what your balance sheet is telling us, because we want that balance sheet to also look healthy as well.